This slide shows the S&P 500 from late 2013, and you can see the blue line rising, reflecting a strong economy, lower financial risk, and a strong stock market. Beginning in the middle of 2015, the stock market flattened out until the middle of 2016 as the economy slowed down and financial risk increased. Beginning in the middle of 2016, financial risk started declining, the business cycle started improving again, and the S&P 500 strengthened and reached new highs. Beginning in 2018, you have these conditions reversing. In other words, financial risk started rising again, the business cycle started slowing down, and sure enough, the S&P 500 really did not do anything during this period. Again, what I would like to do in the next slides is to show you the details of these conditions. This slide shows the financial risk. Really what that is the spread between high grade and low grade bonds. And when the spread declines, obviously financial conditions are okay, there is liquidity. When instead the spreads increases, financial risk increases because the spread between high grade and low grade bonds increases, and the same thing happens here. Now, during the period until 2014, credit risk was decreasing, and until early 2015. And the market was strong, and the economy was strong. Then towards the end of 2014, 15, and early 16, credit risk, financial risk increased, and of course the economy slowed down. There was a down cycle. I show this in other videos, and of course the market didn't go anywhere. Then sometimes in 2016, early 2016, financial risk declined, the economy started accelerating, and the market also improved. Beginning, however, 2018, what you see is financial risk is now increasing again, and as of early 2019 until May 2019, financial risk is still going up. So, and it's not a coincidence as if you look at our business cycle trends, the economy is slowing down and the stock market is pausing. Let's see now what happens next. This is our Peter Dag and Associates real-time business cycle. This is the economy is slowing down. This is the economy accelerating, and this is the economy slowing down. As you can see from 15 and 2014-15, end of 2014 and 2015, the economy slowed down, financial risk was rising, and the stock market did not do anything. Then beginning 2016, the economy strengthened and financial risk declined, and the stock market was strong. In 2018, as you see with our business cycle trend, the economy started slowing down, financial risk, as I showed you in the previous slide, increased, and sure enough, the stock market is going nowhere. This chart shows our real-time business cycle indicator, the blue line. So here the economy is slowing down, here the economy is strengthened, here the economy is slowing down again. And what I overlaid it with is bond yields, the green line. So not surprisingly, bond yields decline when the economy is slowing down, they rise when the economy strengthens, and they decline again when the economy weakens. Again, remember that during this period, financial risk is rising. Here, financial risk is declining, and here, financial risk is rising again. So the conditions for a stronger economy is lower financial risk and the business cycles that starts rising again. Right now, it doesn't show the pattern as in 2016. So we have to wait and see. This chart shows the relative strength of the financial sector, that is XLF. That's the ETF for financial sectors. and I'm computing the ratio between XLF and SPY. A decline of this curve means that SPY is stronger than XLF, or said in a different way, XLF has underperformed the SPY. Why? Because since 2018, early 2018, as I showed you in a previous slide, the economy has been slowing down. And as I mentioned in several times in my videos, financials are strong in a stronger economy, not in a weakening economy. And since 2018, early 2018, financial stocks have underperformed. So this fits exactly the business cycle approach to money management. This slide shows the price action relative to the S&P 500 of the sector real estate. As I did in the previous slide, this is the ratio between VNQ, the real estate ETF, and SPY. If the ratio rises, means that VNQ is stronger, that is appreciating faster than the S&P 500. Why? Because since early 2018, the economy has been slowing down. And as I mentioned several times, real estate sector outperformed the market during periods of slower economic growth. So this, again, the business cycle is very, very useful in order to design and invest your portfolio. So how do we use this information that I discussed it with you? Okay, this is a recap. Higher financial risk means that the economy is going to be weakened. And if the economy weakens, you are going to have lower bond yields. If the economy weakens, you don't want to buy in cyclical stocks, but you want to be in your portfolio, at least this has been our experience, non-cyclical sectors. And these are staples, real estate, utilities, and bonds. When the economy starts strengthening again, which is preceded by lower financial risk, you have a stronger economy and you're beginning to see higher yields, then you move into more cyclical kind of strategy, emphasizing cyclical sectors, and they are industrials, financials, technology, and commodities. Again, thank you very much for reviewing this video. Hopefully it gave you more insight on the kind of work that we do, and our work is discussed in detail in the Peter Dack portfolio, and you can subscribe to www.peterdack.com, and in our 3 books that have been selling quite well, frankly, Profiting Bull or Bear Markets, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think. Again, thank you and hope to see you really soon. So long.